Gerchick again, and our Lunch and Learn. And today we're pretty excited to have Ann Cornelius, who is the CPA, my CPA, but also the CPA that we recommend. And she's going to be talking about passive versus active income and the buckets of income today, right?
That's right. Multiple different types of income we'll talk about, how they work and how they work together and against each other, etc.
There you go. And Ann's a great supporter of our company and is always our resource when we have tax questions, and we love Ann. I do.
All
So
right.
I'm going to step out and Ann's going to take it away.
Okay, thank you, Linda. Okay, well, as Linda mentioned, today we're going to talk about the various types of income, how they work on your tax return or not, losses, how they might affect your tax return, and we'll talk about that from a standpoint of different types of income. I like to call them income buckets. And you'll see why when I demonstrate this in a minute. Essentially what that is income tax, or income categories for tax reporting. So, let's look at the different categories. One category is non-passive income. We've also got capital gains. Another category is passive income. And a fourth category is passive income with active participation in rental real estate. That is a completely separate category, different rules. When you add all of those up, you have total income that gets reported on your tax return. So, let's start with the non-passive income and the calculation for that, how that works. One type of non-passive income is your wages. That would be the income that you receive that's reported on your W-2. Another category is business income, and that would be, since we're talking about an individual tax return, that would be business income that is reported directly on your tax return as a sole proprietor or as a single member LLC. That gets reported on Schedule C. It also could be ordinary income that flows through from your S corporation or from your interest in a partnership. If you are, particularly if you are a general partner and you're actively participating in your partnership, and this is, not including rental type income. Now, we have another category that you would not think of as non-passive, but for tax purposes, it's treated as non-passive, and that's interest and dividends, because they have the same tax treatment as wages and business income. Now, let's just look at some numbers here so you can get an idea, and I can show you some examples of how this is going to work. So let's say wages are $20,000 for the year. And business profits are $40,000 for the year, and your interest and dividends are $2,000. So you've got a total in this category of $62,000. So here we are putting all of that in one bucket. The bucket is the non-passive income bucket. So you've got your wages, they go in that bucket. Portfolio income, that's your dividends and interest, that goes in that bucket. Business income, all goes in the bucket. There may be some other types of income you have too, like for example, gambling income. That will also go in the non-passive bucket. Okay, next category is capital gains. Let's look at a calculation for capital gains. So let's say you sold some land in Payson, and your gain on that is your sale minus your basis, is $12,000. You also sold some stocks and bonds, whatever, and your gain on that's $1,000. You sold some land in Toledo, Ohio, and you lost some money on that one. So you lost $20,000 on this particular sale. So you now have a net loss between all three of these transactions of $7,000. Now, there is a maximum loss allowed in any given year of $3,000. That's true every year, $3,000. So you say, okay, I had a $7,000 loss, but I can only take three. What about the rest of it? $4,000 is carried over to the next year. So let's think about this for a minute. You've got $4,000 that you're carrying over, and it's the next year, and you didn't sell anything. Next year, you can take another $3,000, because that's the maximum loss, net loss that you can take in a given year. So you've got another $1,000 that goes forward another year, and then if you don't have any other activity, then you just take that $1,000 loss. If, let's just say in the second year, that $4,000 loss carries forward and you had $10,000 of capital gains on something else, you can offset that $10,000 gain with the $4,000, with the full $4,000, and then just recognize the remaining $6,000 gain. So you can always offset losses in any given year against your gains. It's just that your net loss can't be more than $3,000 that's reported on the tax return. Okay, so here's the capital loss bucket. Those things go into that bucket. Now you have your capital loss bucket in addition to your non-passive gain or non-passive income bucket. So let's now look at the passive income calculation. Here are some examples of some things that might belong in that bucket. So you're an investor in a limited partnership A, and also limited partnership B. Limited partnership A is going to reflect income of $3,000. You probably get this number from your Schedule K-1 that comes from the partnership. If you're not actively involved in that partnership, maybe that's the only thing you see is that K-1 that comes to you from the partnership at the end of the year. And that K-1 says that your income was $3,000. And you get another K-1 from partnership B, and it says that you had a loss of $4,000. So between those two investments, you have a net loss of $1,000. So, what's your taxable income? What's going on your tax return? So you've got partnership A and partnership B. On partnership A, you're going to pick up the $3,000 of income. On partnership B, you're only going to pick up the $3,000 of the loss. And that is because, kind of similar to what happens with capital gain, is you have to net them together. Except that you cannot recognize a net loss between multiple multiple incomes within passive income. So you're going to limit your loss on partnership B to $3,000 for the year, giving you taxable income in this bucket of $0. You've still got $1,000 of losses left on partnership B, and those are basically suspended. What that means is you just can't use them yet. They get carried forward, just like extra capital losses do. So, the $1,000 capital loss or the $1,000 passive loss from partnership B is suspended and is carried forward to the next year. And any unused losses continue to remain suspended until they are disposed of. So, if you divest yourself of partnership B in a given year and you still have losses that you're carrying forward, now the IRS says you get to use those losses, even though you may not have other partnership investments with income. So every year the same math works. You've got losses you carry forward. Now can I use them because I've got income on another partnership? Yes, no, maybe. if you end up with continued losses, you keep carrying those over until you dispose of your investment in that partnership. Okay, so here's our bucket. Investments with gains, investments with losses. You put those all in one bucket and it can't be less than 0. It might be a positive number because maybe partnership B didn't have a loss, maybe it had income. But it just, you have to remember the passive income bucket cannot go below 0. Okay. Now, we have a limited exception for active participation in rental real estate activity. So even though this is passive, there's an exception. So, you can have up to $25,000 of passive losses in any given year that can be used to offset other types of income on your tax return. However, that maximum starts to phase out when your adjusted gross income exceeds $100,000. So it's going to depend on your income level whether you can use all of this $25,000. You might be able to use $20,000, $10,000, $5,000, maybe 0. It phases out completely once you get to $100,000. It begins to phase out.
Question?
Yeah.
If you don't have any other income besides rental real estate, is $25,000 the maximum, or is there no maximum?
What will happen is that $25,000 will appear on your tax return as a loss if you've got nothing else going on at all. That $25,000 will still appear on your return, and because you don't have any other income to offset it against, what will happen is you'll have a completely separate calculation of net operating loss carryover. And so what you'll have now is what we call an NOL carryover, which is better than having passive loss carryovers, because NOL carryovers, they can be used against anything in the future. So maybe this year that's all you have going on, but maybe next year you start a business and you've got profits. Because it's been converted to an NOL carryover, you can use it against other types of income. Okay. So now this treatment is only available to individuals in the States. You can't do this at a corporate level. Okay, so qualifications for active participation. You participate in making management decisions, or you can actually arrange for other people to make the management decisions, but you're still the one with the final say. So just because you hire a management company doesn't mean that you're no longer an active participant, because you've chosen to use the management company versus being involved in a partnership where you don't have any say-so and someone else makes those decisions. But if you have the ability to make those decisions, you're considered an active participant. And again, I said hiring a management company does not disqualify active participation, so keep that in mind. Okay, so let's look at a calculation. So you have a rental property in Phoenix, and you have one in Scottsdale, and another one in Queen Creek, and you've got one in Levine, and oh, you got some beachfront property too. And you also have a prior year loss carry forward on that beachfront property, because it really was a beachfront property. All right, Phoenix. Your net rental income on the Phoenix property for the year was $1,000. For Scottsdale, it's $2,000. Queen Creek, you lost some money on that rental for the year, $4,000 loss. Levine, you lost $2,000 for the year. Your beachfront property, as you called it, lost $30,000. And there is a carryover of rental loss on your records, on your tax return carryovers, of $10,000 from a prior year for that same property. Your net loss, when you combine all these things, is a $43,000 loss. Okay, You remember what the maximum you can do on a rental? What's the maximum loss? $25,000. Okay, so the maximum loss allowed is only $25,000. So here we are putting everything into the passive real estate loss bucket. Rental property with a loss, rental property with income. So we put all of those in one bucket and we end up with a $25,000 loss. And by the way, the rest of that carries over. You don't lose it. You never lose these losses. They just carry over until you can use them in future years.
There's no limit, no expiration?
No. No, you can continue to carry those over.
And how broad a spectrum can you spread them out on, the losses? I mean, oil wells,
I mean, they all fall into one of these buckets or another. So, you know, you have to figure out what bucket they belong in first, and then the math is done within those buckets. So, oil, most likely, that's a passive investment in most cases. You're just an investor, and you're not a general partner, you're a limited partner, so that's passive. So that all goes in the passive bucket. Yes?
Can I decide how much I can distribute them? Can I decide that this year if I have a $10,000 loss, can I decide this year I'm gonna do only 5,000, next year I'm gonna do 5,000, or I have to use them when I can?
You use them in the year that they belong in, yeah. Yeah, you don't
To
have
their
options
maximum.
as to using them or not using them. If that's the year you incurred the loss, you use it if you can.
Would that really matter what, if you put it in LLC or if you put it in S Corp or C Corp?
If you put an investment in an LLC and you are a disregarded entity because you're the only member, the IRS doesn't even recognize the LLC for tax purposes. It's a disregarded entity anyway, so that won't matter. If it's in an S corporation, then everything will be classified at the corporate level, but it will flow through to you on the K-1, and it will still be properly classified as ordinary income or rental income or whatever the case may be. So you'll end up with the same treatment as it flows onto your individual tax return.
And which one will you structure to flow to individual return? What entity?
Which one? Which entity
What entity would that be?
would which be?
That will flows into the personal tax return?
Well, if an S corporation will flow in, a partnership interest will flow in. They all flow in except for C corporations. Yeah, they all flow into your personal return. Okay, so let's look at the different categories of income together. Okay, so we have the non-passive category. We talked about that one. And if you recall, that was the first one we did. The net total income on that was $62,000. That was the wages and the business income, etc. And then we looked at capital gains, and recall that we had a net loss of, I think it was $7,000, and we can only use 3. So we have a $3,000 net loss. And then we looked at passive income, and that's the one that had the partnership A and the partnership B, and we determined that we had to we were limited to 0 because you cannot have losses except in the year that you dispose of the properties of the investment. So we're making an assumption here that they still own partnership B, so they couldn't do that. Okay, and the other one is passive income with active participation in rental real estate. And we use the $25,000 loss limit. We made an assumption here that their adjusted gross income was under $100,000, so this wasn't limited. Okay, so we now have a total net income of $34,000. So this is really how that whole thing works. You have to look at what bucket your different types of income belong in. So if you have a loss on rental property, keep in mind that it may be limited. If you have income from another rental property, they can offset. And everything has to be, all the math needs to be done within each individual bucket before it goes to the tax return. And also remember that all of these losses that you don't get to use, they get used eventually. Now the rental situation works similarly to the passive loss limitation. Remember that Partnership B had a loss that you couldn't use, but I said that if you sell your interest in Partnership B, now you can take whatever losses are still carrying over. The same is true for your rental properties. So if you have rental properties that, and I see this a lot with my clients, where their income is too high. So they're renting out a property year after year after year, and they have all these losses, but they don't show up on their tax return because their income is too high, so they're beyond the phase out now for the $25,000 loss. So those are just carrying over and carrying over. Now all of a sudden they sell that rental property, all those losses can now be recognized in the year of sale, which is helpful, particularly if you have a capital gain on that property, because they will offset that. So,
Do any other losses offset income, a gain on real estate?
the gains on real estate are offset by losses on real estate. Everything is done within that same bucket.
But not
Okay.
other passive income.
Except for, the only other thing is the capital loss of $3,000, the $3,000 limit, because that's going to roll onto the tax return. So that $3,000 gets used against whatever else is on page 1 of the tax return. Okay. So here's kind of the picture of, everything going into the income bucket. Now all the other buckets get dumped into the big bucket. And now we're on the tax return. Okay.
Is there any way you can give us those, I like the bucket thing, just want to look at it.
Yeah, oh, absolutely. If you, and I have your card already, I can email you the slides.
Yes, please.
Absolutely. Anybody who wants the slides, just let me know after.
What if you invest in a company, 100K, the company has some, I don't know, properties, and how can you write it off your taxes?
And the company owns properties.
Yeah,
And you're invested in it.
yes,
I'm assuming it's a partnership?
yes,
Okay, so you're going to get a Schedule K-1. Are you a limited partner or are you a general partner?
limited.
Okay, so that works the same as in my example, you have partnership, in the example of Partnership A and Partnership B. Those are passive because you're a limited partner. That makes it automatically passive. So and you'll get a Schedule K-1 and it will show you the activity of that, the net activity of that partnership for the year. It might show you had some ordinary income. If it's properties, maybe you've got some rental income or loss. You're gonna pick those numbers up and put them on your personal
I
return.
mean the actual investment. If I bought like share in a
Mhm.
partnership,
Yep,
but there's no gains or loss, but I invested 100K in that company.
Mhm.
Can I write it off somehow as loss?
It's not written off as a loss unless you lose it. So if you invest the 100,000 and it's an active company and it's, maybe it hasn't generated any income
Yeah.
yet, but you don't write that off. But let's just say you invest 100,000 in a company and it goes belly up right away and nothing ever happens and you don't get your money back, then you can write it off. You have to exercise all efforts to get your money back first. So, I have a client right now who invested in something and the company went bankrupt and it was real estate related. And he had to wait until such time as it was determined, and it went through bankruptcy and whatnot, it was determined ultimately that he was never going to see any money. And at that point, he could now write off what he has put into the company and not gotten back. Otherwise, the expectation is you're going to get your money back at some point in time. If it's an active company, it's still doing business, it hasn't filed for bankruptcy, that sort of thing.
I know that you can invest for like, you know, in a company that have like machinery and you can do some kind of depreciation each year from that.
Sure.
Can you do that on a company that owns real estate to get the depreciation?
Well, the depreciation happens inside the company. It's not some, if you're a limited partner, you're just going to see the bottom line net figure. They will take care of the depreciation figure. But yes, when you or an entity buys equipment, then it does depreciate over its useful life. The life depends on what the IRS determines is the life for that type of asset. But that will happen at the partnership level. And you won't be doing any of that math. It will be embedded in your net income number already. Other questions?
Yes. So in real estate investing, there's 4 different ways that you make money in real estate: appreciation, depreciation, cash flow, and amortization, those 4 pieces.
Sure.
And when I bring a partner in, when my partner and I bring in an investor as a partner, and we're giving them, say, 33% of the ownership of the LLC,
Okay.
all 4 of those pieces, though, are negotiable. So if we give one partner, the person that's coming in with the money, if we give them, say, 80% of the depreciation, because they're putting in most of the money, they have most
Sure.
of the risk, that depreciation goes into which one of these categories that you were telling us about?
Well, that depreciation is part of, if you're talking about real estate then?
Yes, it would be.
So it's part of the passive activity of the entity. I mean, I'm assuming it's a limited partner, or it could be, it's either gonna be passive or passive with active participation, depending on how that's structured. But
Yeah.
that depreciation is simply one of the expenses that goes into the calculation of the net rental income.
Right, but there's three partners.
Mhm.
We don't have to split that depreciation.
Right, and that's all
Three-way.
done at the accounting level.
Right, right. And
Yeah.
so my question is, if we're giving an investor most of the depreciation, but you're saying that they can't use it because it can't go below 0, then it sounds like there's no benefit. Like, say it's a doctor, he's making a ton of money on his non-passive income. And then what we want to do is we want to give him tax benefits to offset that.
Yeah, and he's probably going to be at an income level where, well, first of all, we're not talking about active participation right now. We're talking
Right.
about straightforward passive income.
Right.
Okay, so he may have a higher net loss than the other partners do because he's got the depreciation expense on his. So he'll have that, but he won't be able to use that until he liquidates his interest in the partnership, because his income level will be too high. We're making an assumption here that it's over the phase out period.
Okay, it
Okay.
sounds like you said for passive income, it can't go below 0,
Correct.
but it would be below 0 if there was no other income
Well,
except for
it will go below 0 as it flows through and shows up on his K1. Taking it from the K1 to his individual return is where he's going to be limited. Okay, so
Okay.
on the partnership side, it's gonna report, yeah, he's got this loss. But when he goes to do his tax return, his accountant is going to say, okay, great, we have it, we've recorded it, you can't use it against your income this year, but we're carrying it forward. Now, he might have another investment in another passive partnership where he can offset that.
Right,
But
okay.
he can't offset it against, his business income or his wage income or portfolio income, anything like that. So, yeah, you just, anytime you're involved in something like that and talking to investors, your best bet is to just tell them to make sure that they seek the advice of their CPA. And then you don't have any risk there, because everyone's situation is different. Maybe he's going to have a loss he can use. Maybe he's got limited income, or maybe he's got another investment that you don't know about that's doing quite well. So you're not going to be able to advise him what will happen on his personal taxes. So you always have to just kind of qualify all of that by saying, you know, we highly recommend you seek the advice of your CPA as far as the tax consequences of savings, et cetera. So,
Sounds good.
Jay?
And is raw land always totally passive?
Yeah, it's passive. You know, I mean, unless
I
it's
mean,
a
you're not out
farm,
there
unless you're
farming,
farming or
right,
something, but
right, right.
yeah, but typically it's passive and it doesn't have depreciation because it doesn't depreciate, so.
So if you have raw land and, commercial property, there's no way